Good afternoon, everyone. If you're calling in from the East Coast, or good morning if you're not on Eastern time zone. Thanks for joining our quarterly webinar series. Today we have a special webinar here. We have a special guest speaker that's going to be talking a little bit about the markets and investing and a market outlook for 2026. We have Jeff Buchbinder, who is our Chief Equity Strategist here at LPL. To give us a wonderful presentation. As we are going through this, if you've attended these quarterly webinars that we do before, you know that we always open it up to questions at the end. Today, we're going to ask that you email those questions over to us, and then I'll be able to read those off at the end. You can email any questions to info@sideswealth.com. Again, that's info@sideswealth.com. And I will receive those and I will be able to ask those questions at the end. So without further ado, I will turn it over to Jeff.
Thank you so much, Emily. I appreciate it. It's great to be with you all to talk about LPL Research's 2026 outlook with our nice co-branding here with Sides Wealth. So I'm not going to do the whole outlook presentation, but I'm going to hit the three main sections today and just kind of scoot through the rest. And I'm happy to cover other things certainly in Q&A. So I'll start with the economy, then I'll go through our stock market outlook, and then finish up with the bond market quickly, because I'm an equity strategist, and so I don't like to talk about bonds too much. So we'll start with the economy. Well, first of all, we titled the outlook Policy Engine. Actually, I just got some hard copies today. That's one of the reasons I came into the office. So if you'd like me to send you some hard copies, let me know. But it's, of course, available digitally. So we titled it the Policy Engine because this market, like 2025, is going to be driven a lot by policy. We see that virtually every day out of the White House. But if you step back from the day-to-day and look at some of the biggest policy drivers for the markets, certainly you've got to talk about the stimulus that's coming in this year from the One Big Beautiful Bill Act. And certainly you have to talk about the midterms. So the nature of the policy tailwinds and headwinds is a little bit different, but certainly there's some similarities with what we were dealing with in 2025. In terms of the economy, we titled this "The More Things Change, the More They Stay the Same," because there are some of the same drivers. But I would actually argue, and this is our GDP forecast, I would actually argue that the most important point to convey with the economy is that all it takes is that stimulus spending and artificial intelligence investment for the U.S. economy to grow more than 2%. Just those two things alone is really all we need. That spending is coming. There's almost no scenario where the artificial intelligence investment boom stops this year. And of course, the stimulus is law. And so those dollars are going to be spent. So a recession is, I don't want to say impossible, but very, very hard to envision for 2026. And by the way, when I presented this to other folks over the last few weeks, I've been saying that, our official forecast is 2%, but I think there's upside. Well, I'm actually hearing rumblings that we might raise our forecast, our house view. So I think we can do better than 2 because you don't really need much more than just a little bit of contribution from everything else, right? Besides the stimulus and AI. So artificial intelligence investment is, of course, it's like software, right? It's intellectual property. So Jeff Roach, our economist, talks about how intellectual property is going to be a bigger part of economic growth in 2026, and that'll continue probably for many, many decades. It's just becoming a more digital economy, but a digital economy is a more productive economy, and a more productive economy means that corporate profits can rise as profit margins expand. The other important thing to keep in mind with all of this investment in AI is that it's going to help us limit inflation pressure going forward, right? The best economies and the best markets come with strong growth and less inflation, right? Generally speaking, that's what we had in the late 90s. Of course, as we all know, we went a little bit too far during the internet boom, the dot-com boom. But for a lot of that, the reason that boom went on for so many years is because you had low inflation, strong growth, strong productivity. We think we're repeating that, but not with the same type of stock market volatility that certainly we had in 2000, 2001, and 2002. So it really is a good thing. So I mentioned inflation. So here's a chart of a private sector survey of inflation. So essentially, the ISM, the Institute for Supply Management, asks businesses, do you think inflation's or prices will rise or fall at a faster or a slower rate? You know, aggregate that up into a data point. 50 is increasing, below 50 is decreasing. The blue line is this ISM survey. So this is telling you that there's going to probably be a little bit of a pickup in inflation in the short term. I just heard it this morning when I was listening to President Trump speak, and several people interviewed about his comments, and they were talking about how tariffs are not fully reflected in prices just yet, because there are a lot of ways that companies deflected those tariffs. Some of the rates are actually still changing, right? That was the threat the other day about Greenland. We'll see if those tariffs come in. But the combination of the delayed impact of tariffs and the fact that some are just scheduled to hit later, we think probably drive up inflation just over the next few months. But then we'll probably come back down. So our forecast is for inflation to be lower than it is right now. As the economy slows and the Fed cuts rates, you'll probably get lower interest rates and a little bit of deceleration in prices, or disinflation, lower inflation. Prices still rising, but just at a slower rate. This is the mortgage, the rate of a 30-year mortgage. It's come down as the 10-year yield has come down. This can support the housing market if it comes down further. As we get a new Fed chair and potentially, actually we'll know this week, I guess, or very soon, if Trump's going to have 3 seats to replace or 2 because of the Lisa Cook Supreme Court decision about whether she can be legally removed or not. Anyway, there's going to be more doves on the FOMC. We don't know exactly how many or exactly who, but there'll be more doves biased toward lower rates. That should help bring mortgage rates down. And then you saw this recently, maybe that Trump ordered the Fannie Mae and Freddie Mac, the mortgage servicers, I guess you will, or the mortgage-backed securities support. I think it was $200 billion that he ordered those agencies to buy to support the mortgage market, to try to narrow the spread between mortgage rates and treasury yields. So there's a relationship here. You can see that clearly in the chart, but hopefully spreads can tighten, and we'll get mortgage rates back down in the 5s. We're a little over 6 right now. So here's our forecast. This is GDP. This is going to go up. I can't promise you that, but I'm pretty sure that this forecast is going to go up. So we'll call it a little over 2 for US GDP in 2026. That's potentially going to be about double the Eurozone, potentially about double Japan. Europe has stimulus of its own, so they could have a little bit of upside to this as they spend more on defense and infrastructure, thanks to the prodding of the White House. But Japan too. Japan's got rising interest rates, and they need to support the yen, but they can probably grow more than 1%. So that's not too bad. By the way, everybody's going to benefit from AI investment, not just the US. So these seem like reasonable forecasts to me. But you've still got enough growth in the US with enough tech earnings that I'll show you in a little bit here that we think the macro backdrop for stocks is very positive. So we're not predicting another 16, 17% kind of a year. It's possible. We've had double-digit returns 3 straight years. There's a possibility of a 4th straight year, even though that is rare. But we have the components that we need to potentially do that. So our forecast is for a little less than that, high single digits, but we can see upside certainly. And in the Outlook publication, we actually have a bull case and a base case. So the base case is 7,300 to 7,400. I think we're at like 6,850 now. And then the bull case, actually, we think we have a shot at maybe even 7,800. That would be outstanding if we can do it. The other thing I'll mention, emerging markets, sure, they're growing fast, and we've gotten more interested in emerging market investing because of how well those markets did in 2025. But this is a slowdown, and China still has some problems with their economy. So we wouldn't go crazy with our emerging market investing. We're just proponents of global diversification right now, maybe a little bit more than we were a few years ago. Because remember, international equities underperformed for most of the last decade prior to 2025. So we've been a little bit cautious, but now you've seen enough time and enough progress, I would say, economically, that we're comfortable at least targeting benchmark weight allocations to international and to emerging markets. So that's where we are. That's kind of a good segue to stocks. So we'll go to that next. I mentioned there's a pretty good backdrop for stocks to continue to move higher in 2026. If you get that 2% plus GDP, if inflation comes down, maybe not in the next couple months, but comes down over the course of the year, and interest rates stay in the range where they have been or lower, we think that there's almost no way that this market doesn't go higher. By the way, we just heard it this morning from President Trump that he cares about the stock market, right? He mentioned it a number of times. Just like he did in April of last year when the tariffs were tanking the market, he came back and said, this is a great buying opportunity. He pulled back the tariffs and we were off to the races. This is obviously a much more limited example of that because, what were we down? We're like 2.5% off of all-time highs. It's hardly even a pullback, but nonetheless, he cares about the market. So we think that the policy, generally speaking, will be supportive. We'll get profit margin expansion, strong earnings, and that should help stocks go higher. So this first chart in the stock section, it just shows you how bull markets do by year. The light blue bars here are the year 4s. These are the last 7 bull markets. And you can see here, at least since 1957, the last 6 bull markets, year 4 was up every time. 28, 6, 30, 1, only 1. So we were barely up in the 1990s bull market in year 4, but that one kept on going. 13 and 13, right? So this year 4 started in October of 2025. When we published this, we were up about 5% for year 4. We've added a few points to that. We think we can add a few more points between now and October. So we've been up 6 straight bull market year 4s. We think we're going to do it again. And bull markets tend to go 5-6 years at least when they last this long. So we think there's a good chance that this keeps going. Now, when a bull market ends, if you look back at the last, let's call it, 8 to 10 bull markets, it's either recession, a pandemic, an aggressive Fed rate hiking campaign, or a financial crisis, right? So clearly we had a financial crisis in 2008. It wasn't just your garden variety recession. Of course, we've come back from all of those. We're near all-time highs today. We don't see any of those things happening in 2026. If that's right, then this is probably going to be another 5-6 year bull market or maybe more. They have gotten a little longer as economic cycles have gotten longer in the last few decades. So we think we got more upside. Here's another reason to think we've got more upside and this bull keeps running is when the Fed cuts, when the stock market is near highs, you tend to get a nice further gain in stock prices after that. So this shows you the 12 months after rate cuts when stocks are at all-time highs. So we identified 28 cases. I think this goes back to 1984. So this is not really a small sample size. All of those rate cuts, on average, stocks are up 13% 12 months later. If you break out recessions, you're either down 3 or up 18. So now there's not a huge sample size for this down 3, right? Only 7 recessions when the Fed cut near all-time highs. Again, we don't think we're going to have a recession. It's really hard to even make a case for one. That's why you haven't heard too many people, if anybody, make a case for a recession. So I'm not going to say we're going to be up 18, but I think you can make a case that we're going to be up mid-teens. Not our base case, but wouldn't surprise me. And so here's one of the reasons why. We're getting this massive amount of investment in artificial intelligence capabilities by the big tech companies, what they call hyperscalers. So this isn't the Mag 7. This is just the 5 companies essentially building data centers. Amazon, Microsoft, Google, which is Alphabet, Meta, which is Facebook, and Oracle. Those 5 companies are expected to spend $520 billion this year on CapEx, which is pretty much all AI related. Essentially, they're spending all the money they're making on building out this capability. They sure believe in it, and they've got me believing in it. So why does this matter? Well, 2 reasons. I touched on one already. It's going to drive GDP growth and productivity, which again is a good backdrop for stocks. You don't want too much growth, and you don't want too much inflation. So we think there's a possibility that this kind of hits the sweet spot. But the other reason it's important is because this spending is going to be earnings for somebody, right? And a lot of it is, of course, going to go to the chip makers. So the NVIDIAs, the AMDs, the Microns of the world, right? The tech sector is going to grow earnings, we think, at maybe 30% in Q4, and probably similar to that for 2026. Q4 is being reported now. Earnings season just started. We haven't even gotten really many tech companies, but they're going to come fast and furious over the next couple of weeks. So here's the Mag 7. This is a different way of representing tech by just using the biggest 7 companies that are related to the AI theme. This does include Tesla. It's an AI name too, but if you add Broadcom and Oracle to the Mag 7, you really have a massive amount of earnings growth. So here's that 25 to 30 kind of range. Oh, I'm sorry, there it is, Q4. 20% is consensus. They will beat that. They've been beating that by double digits for many quarters. We think it's going to happen again. So we'll have, we think, 30. The rest of the market probably only about 10, if that. But over the course of the year, that gap will close. So that's the orange bar, the 493, right? The rest of the S&P 500 that is not in the Mag 7. That gap closes. We think that's helping value stocks right now. So we want to keep our value stock, our value growth mix, we think, fairly balanced. We're leaning a little bit into growth right now, but I think our next move at some point in the next several months is probably going to be to square that up. It's good that this market is broadening out and it's not just 7 companies doing all the work. So this is a good story. It's good earnings, high level, and it's broader earnings, which we think is better for the stock market. So a few reasons why we're excited about the AI investment. Although I will say that AI is a risk too, because if the market gets disappointed with how fast it's being deployed, or how productive it's making companies who use it, then you're going to have sell-offs in these tech stocks. So we're neutral tech. We're not overweight tech. It's 34% of the S&P 500. So you've got plenty of tech. Basically, no matter how your portfolio is set up, you've got plenty of tech. A neutral is a pretty optimistic view because you're going to have that big chunk. But we think we want to be a little bit careful. We had disappointments in AI at the beginning of 2025 when China reported their advancements. You've had some concerns about whether this spending will even happen. Right? We think those concerns are maybe overblown, but certainly that affected Oracle's credit default swaps. Markets were worried about Oracle, whether we're going to get too leveraged to try to build all this capability out over the next several years. So that is a risk. I would argue that interest rates are a bigger risk. And then the midterm elections are a risk as well. We think interest rates, again, are going to go down. But if we're wrong and they go up, you're going to have a little bit of a choppy stock market accompanying that. So this chart shows you the midterm election year performance. So this is breaking all the years of the stock market since 1950 into the 4-year presidential cycle. So we just finished a first year in office, even though it was second term. First year in office is typical. You're on average up 10%, but you have a drawdown of 14 on average during all those year ones. That is consistent with the average for all years combined. An election year is similar, right? It may not feel like this, but the average drawdown in any given year is mid-teens. Last year, you felt it in April and May, right? You don't get that kind of drawdown every year, but it's important to make the point that you can draw down 15% and be up 10. That is very typical. Actually, last year we did better than that. We drew down 19 last year, and we ended up 18, roughly. So don't be scared off about these drawdowns. They're actually more opportunities, more often than not, certainly. But I want to also bring your attention to the midterm year. So the orange section of this bar is the drawdown, average drawdown. Look, it's about 17. So why is that? Well, because the market is worried about policy changes, typically. Now, I would argue this time because the majority in the House is so narrow, and the party in power loses seats at the midterms almost every time, I think the market's going to price in gridlock after the midterms. In other words, the Republicans losing the House, keeping the Senate. If the market's comfortable with that and prices in ahead of time, then you might not have a lot of volatility around the midterms. There's certainly no big tax package on the docket. And tax changes are what really affects the stock market, right? We've seen that in 2017. We saw that a little bit in Trump 2.0. Tariffs are taxes, essentially. So tariffs can move the market because they affect corporate earnings. Taxes can move the market because they affect corporate earnings, right? We don't think there's going to be a big sort of divergence in the path of taxes or tariffs, frankly, in 2027 as a result of the midterms. So I'm going to argue here that midterms won't be that big of a deal for the market, but you'll probably get a little volatility ahead of the midterms, like we normally do. I don't want to dismiss that risk. So that's something to watch. All right, let's turn to bonds, and then I'll kind of wrap up. So the navigating neutral, that's kind of a wonky, fixed income jargon expression around neutral. What Lawrence Gillum, our chief fixed income strategist, means by neutral is the rate at which the Fed is not stimulating the economy or sort of, tightening and contracting the economy or slowing it down, right? They're just having no effect. They're neutral. And we don't think the Fed is quite there yet, but they're getting closer because they've already cut rates a bunch of times. We know President Trump certainly wants more cuts, and we're probably going to get more cuts. Our base case now is that we're going to get 2 more. Now, remember, the Fed only controls a very short-term rate. It's effectively the rate that banks borrow from each other. But we care more about the 10-year yield because, as I mentioned before, that controls mortgage rates or correlates strongly with mortgage rates. It's also a lot closer to auto loans, to your typical small business loan, right? Your home equity loan, right? Auto loan. All these loans are typically going to be, let's call it 5 to 30 years. And that's where the 10-year yield really matters. So how do we draw a relationship between what the Fed's doing and the 10-year yield? Well, you look at expectations. You look at where is the Fed going? So this chart shows you where the market thinks the Fed will be in a year, right? December 2026 implied Fed funds rate. Right now we're at 3.5. So if the Fed doesn't cut, that corresponds to a 10-year yield in the 4.4 range, roughly. That will be a little up from where we are now. Of course, we think they're going to cut. When Trump puts his own people in there, including the chair, you're more likely to get cuts. He's certainly going to use that. You know, he's putting a cutter in charge, right? And it's a whole committee approach. You can't just have the chair do it unilaterally. But if you put 3 people on there potentially, you're going to have a much greater likelihood of cuts. So we're going to have probably 2 cuts. That would take the rate down to closer to 3. So what does a Fed funds rate of 3 correspond to? 4.2, we'll call it. 4.142. That's about where we think we're going to be, at least at the upper end. Our forecast is 3.75 to 4.25 for year end. So, you know, maybe we even get a 3rd cut. But that really syncs up with our view that inflation will come down over the course of the year and the economy. It'll pick up later in the year as the stimulus flows through, but we're still digesting higher rates from the past couple of years. We're still digesting tariffs. We all know that the job market has slowed a little bit, right? We're not creating as many jobs as we were a couple of years ago. The unemployment rate's up over the last couple of years. So the economy has slowed a little bit. So there'll be a little bit of a soft patch maybe in the near term before we get a pickup, but not enough growth to drive inflation sharply higher. And that is good news. Good news for bonds and stocks. So we actually I'd say we like stocks a little better than bonds, but we're pretty close to neutral on fixed income too. We like the fact that you get a good starting yield. You know, a lot of fixed income portfolios can yield 5% plus right now still. And then you've got the potential capital appreciation if the economy does worse than we expect or if the stock market drops. You're going to get that diversification benefit, we think, from bonds. So we're pretty much, you know, neutral on bonds, neutral on stocks right now. All this says is spreads are tight. So what does that mean? It means the credit markets are not scared about an economic downturn. The credit markets are very good predictors of recession. And essentially, the corporate bond market is saying nothing to worry about. Will this still look like this in a year? Hopefully, maybe not. It's about as tight as it gets. The market is as complacent about recession risk as it pretty much ever is. So I'm not going to say this will look like this in a year. At some point, you're probably going to get a growth scare. I don't know what will cause it. Tariffs, some geopolitical event. Who knows? Maybe unwelcomed and surprising inflation causes the Fed to hike. Again, not our base case, but possible. Hard to say. But we think this is probably a sign that we're not going to have to worry about recession in 2026. So that is, you know, high level our bond market outlook. So I mentioned that we're getting good starting yields. This break-even rate change column, you can see there's a lot of like 0.7, 0.8, even 1% with intermediate corporates. What does that mean? It means that even if rates go up by this amount in this last column, these bond sectors can still generate positive returns. So just to use corporate bonds as an easy example, right? The Bloomberg Corporate Bond Index, if rates go up 70 basis points, corporate bonds will still have a positive return, right? Or zero, basically. So you've got some cushion if rates rise to still generate a positive return for your corporate bonds. Now, again, we think rates are going to go down a little bit from where they are right now. So that's why you see better returns than, obviously, better returns than zero. In this base case, if we have no change in rates, let's call it 4 to 5% return, actually 4 to 6. We'll call it 4 to 6% returns in bonds. But if rates come down a little bit, that's when you introduce the possibility of 6, 7, 8% returns. That's what we did last year. So bull case, which implies we're not going to bet on it. It's not base case, but certainly possible. So we think bonds are still a pretty good place to be. So I'll wrap just by saying we do like having a sliver of alternative investments in portfolios. As M&A activity picks up and the capital markets environment gets more active with IPOs and things, you have more opportunities for alternative investment managers. Although they can't buy single family homes anymore. We learned that recently. The Trump administration executive order says that these institutional asset managers can't buy single family homes to help keep home prices from rising. So currencies, I'll just make the point that the dollar is at this inflection point. If the dollar breaks this uptrend, we think there's a possibility for the dollar to be quite a bit lower. And that makes us more interested in international investments. So keep this in mind. There's a potential catalyst for international to do really well and emerging markets to do really well again in 2026. But the dollar's probably going to have to help like it did last year. It's not clear that it's going to help, but it's probably more likely to help than hurt. And then commodities. So this is another reason why you might see a touch of inflation in the next few months, because commodities have been a little bit of an uptrend here. You've seen what's happened in precious metals. Gold, I get asked about gold every call I do. The build out of the data centers is putting upward pressure on copper prices and certainly some other metals. There's a little bit of supply tightness in some of these metals. So that's something to watch as a potential near-term signal of more inflation. And then this is a chart to show that gold has been supported by central banks. When Russia invaded Ukraine, central banks started moving, talking about foreign central banks, started moving away from the dollar. They didn't want to get sanctioned like Russia, right? We froze some of their dollar assets shortly after the invasion. Certainly the same thing with Iran and some of these other bad actors overseas, right? The Iran regime, not the Iranian people. Important distinction. The bad actors are the regime. So the central bank buying all over the world that's that aqua colored bar, part of these bars. That was pretty small after the pandemic. And then right after the Russia-Ukraine invasion, it started to get a lot bigger, and it stayed big. So that has been a huge support for gold. Gold's actually pretty close to 5,000 now. Unbelievable. Had a massive run. You can see here on this chart that gold has far outpaced the S&P 500, even though the S&P 500 has done quite well. So we like precious metals still as a small part of portfolios. We've had that view for more than a year, and we stuck with it as 2026 has begun, largely because of the central bank factor. So that's all I got. I will wrap up there and just say thanks for your attention, and I hope you found that interesting and informative. And I'll show you these disclaimers, which are very important. You will read every word, I am sure, as I show these all to you. And let's get into the fun part. Let's take some questions. I hope you have some.
Thank you, Jeff. We do have one question so far. So just a reminder, if anybody does have a question, you can email info@sideswealth.com and I'll be able to get that over to Jeff to answer. So what would you say is the biggest takeaway that someone should walk away from this presentation with?
Biggest takeaway. I would say, well, you know what? I'll give you two. One message is it's a good time to be diversified globally, right? As the stock market broadens out and more stocks work, you want to, right? Small caps are working this year, international is working this year. This is the type of environment that's good for all of us, right? You build a diversified portfolio, and most of it, if not all of it, is going to help you achieve your goals or get closer to your goals, certainly in 2026. So that's one message. I think stay diversified. It's going to work better in coming years than it's worked over the last few years. And then my other message is just that don't think just because we're up so much in the last few years and stock valuations are high that this bull market is over. The bull market needs one of those catalysts I mentioned before it's going to end. And it's very hard to make a case that any of those catalysts are in place or will be in place in 2026. So stay invested. So I kind of cheated, Emily, gave you two key
No,
takeaways. Stay
I
invested,
think
stay
that's great.
diversified. It's a good time, certainly to be an equity investor, and not a bad time to be in bonds either.
Thank you, Jeff. We haven't had any other questions come through, so I think we can wrap it up. So thank you so much for your time and insightful information, Jeff. If anyone else has any other questions offline, you can always email us and we can get those over to Jeff to answer. We're happy to do that. So thank you all for your time. Hope you have a great rest of your day and happy 2026. Happy New Year.
Thanks, everyone.